Hi everyone, this is Phil at Laptop Trader and at Laptop Trader on YouTube. So this is going to be our last video of the year. It's going to be extremely detailed. It's going to be my longest video of the year. Should be an hour, maybe even longer. I tried take one and it went a little bit too long, so this is take two. This is going to be my last private direct video or email to you guys. I'm going to include the video and the slides for you. And then next year, I'm just going to do YouTube at Laptop Trader. You guys can find me there. You can watch, like, and subscribe if you wish. I'm also going to have a website sometime in January for members only. So next year, there will still be a free video on YouTube once a month, but members are going to get more if they sign up through the website, which will include weekly updates and different things I see in the market on a weekly basis for members. So, um, nothing I'm going to say in this video should be looked at as trading advice, recommended investment advice, or anything like that. I'm not a registered investor or investment advisor. So this is for education only. But ignore this cycle, ignore the stages of any market at your own risk. Okay? This is real stuff. I'm going to show you a real trade I took for an example. And so you guys can hopefully take from that and learn from that. So it took me a little bit of time to put this together. What we're going to cover, well, today it's going to be all technical analysis and why we use technical analysis versus just simply something like fundamental analysis or cost to earnings or price to earnings ratios or revenue increases or decreases, stuff like that. Now, that stuff is important. There's no question about it, especially in this market. Right now, companies that aren't making money are going to be punished severely for not performing. But in an up market, sometimes earnings and revenues and that stuff just doesn't seem to matter over the last, really over the last decade. So we're going to go over relative strength. Um, we're going to go cover some risk to reward with a real example. Kind of maybe how to kind of set up your game plan with multiple time frames and kind of where we're at in the stage of the market right now or in any individual stock. We're going to cover risk and or money management. It's okay to lose some battles, but not lose the war. Okay, you're going to have losing trades, so you need to plan for that. 99% or so, at least over 90% of day traders fail. In other words, they go into the market uneducated, they take some trades, maybe even take out a loan. You know, there's been stories of students taking out student loans, trading or gambling with student loan money, and losing it all. Well, I don't want to see that happen to you guys. That's why I'm giving you this information. So, but you can win with even a fairly low batting average. I know one multimillionaire trader, he bats about 35% and still does very well because he's willing to take his losses immediately. I personally bat around 55% or so. So I have, you know, about 55% of the trades I'm right, 45 I'm wrong, but I take my losses. So anybody can read a chart, anybody can open a platform, get an account, anybody can trade. But the question is, can you make money? That's the real question. And the reason why people make or don't make money in the market is because of that one subject, risk management and money management. If you don't have it, you shouldn't trade. So this will be a slideshow and a video, and I'm going to try to move quickly through it for time purposes, so you guys can have this if you want it and review it. It's going to be on just a Google slide, you know, with me doing a video presentation. And the stock we're going to cover today, this is the only stock we're going to cover today, is going to be Zoom, symbol ZM. So that's what we're going to go over. And as to what looks like a probability going forward, where it's been at. And we're going to cover the 4 stages. That's going to be our focus. And these 4 stages cover any market, any product, any service, and in any time frame. So just think of something like something that's obsolete right now, like compact discs or video DVDs. They're not totally obsolete, but certainly the market went towards live streaming, like Netflix and Hulu. So that would be an example of where prices and services were in a uptrend, kind of topped out, fell out of favor, and then the next product or service comes along and starts a new trend, okay, or a new stage. So just kind of maybe think of that when you're looking at the different stages of the market. So it's real simple. There's 1, 2, 3, and 4, and either back to 1, back to a 2, or many times back to 1 and out of business. So this will be pertinent information for you guys. So we're going to do a trade review, a trade I took, and kind of why I think it didn't work too towards the end. So again, this has been in other videos, but again, this is just a different look at the 4 market stages. 1, 2, 3, and 4, and then back to 1. It's just a line chart without any numbers, any moving averages, or anything like that. You know, one of the things that's interesting about this pattern is why does it repeat itself? You can look back hundreds of years if you want, and basically it's because people repeat themselves. You know, human nature really hasn't changed. So in the 4 stages, within these stages, you can have uptrends, downtrends, and sideways trends. A professional trader can make money on any security in any of these trends using different techniques. This is kind of what we're looking for. Most investors only know one thing: buy the stock goes up, I get rich over time. That's basically what most people know. There's a lot of other ways to make money in the market. So the first stage is accumulation, or the buying stage. It's also a stage of indifference. There's not a lot of popularity behind some of that. It can also be looked at as a consolidation, sideways. And then as maybe something gets more popular, you think of maybe your favorite pair of shoes or your favorite outfit. All of a sudden everybody's got to have it, right? So that's stage 2, greed. In an uptrend, the trend goes up, and many times it just looks like stairs going up as buying takes place. And buyers are willing to buy at ever higher prices through this stage. Then you'll have a stage 3, which will sometimes be called distribution. There'll be some selling taking place in this stage. Oftentimes it'll also look like a consolidation, just like stage 1. And essentially what you're seeing there is more of a maturity of a market or maturity of a product or a service, where everybody that wanted to buy has bought, and now they're just kind of holding on to it, like people used to hold on to their Walkmans or their old phones. Some people hold on to their old phones forever, don't get a new upgraded phone. That's kind of what you're seeing there. And finally, you have stage 4, which is fear. This begins, and this downtrend can continue for quite some time. Sometimes Wall Street refers to stage 2 as stocks take the stairs up but take the elevator down. We can see some of that on some of the charts today. But this is pretty much selling. There'll be some buying within stage 4, but it'll be quickly sold off until sellers stop selling and buyers finally step up and start buying again. Basically it. If you could see that, if you're a 3rd grader or a 6th grader, or for sure by 8th grade, you should be able to recognize the cycle over time in any chart or any company. Unfortunately, most investors buy in late stage 2 or stage 3 or even in stage 4 because they just have to have it. And that's one area where I really want you guys to pay attention, because most Americans are poor investors and certainly poor traders. So because they ignore this cycle, that's why. And many times prices will come what's called back to earth or revert to the mean, if you ever hear those phrases on TV or in the news. It means prices won't get so extended that now they're coming back to earth or they're reverting to the mean. And many times you'll see in a recession where there's like this flight to quality companies, qualities that are making valuable products and services, companies that are making money, companies that still have growing earnings and growing revenues and a growing customer base. And we've seen that most recently in something like Meta that was sold off heavily because they kept missing earnings or missing their subscriber numbers. People started, I guess, logging off of Facebook, and so that they got punished for that. Next slide is just this stage is what it would. This chart shows what it would look like if a company or product resumes an uptrend after it's been sold off. This is kind of what you would see, and that can happen, especially with quality companies. We're also going to look a little bit, but not much, at support and resistance and trends. I'm not going to read through this, but support and resistance can be objective, and it can be skewed sometimes based on what you're looking at. So if you're looking at a 60-minute chart, that may look like it's up, trending up, near resistance or above resistance, whatever, or above support. Yet in a longer term time frame, like a 6-month daily chart, it actually may be in a downtrend. So you need to consult the higher time frames so that you get a clear picture of what's really going on in these market stages. Okay. So we're just gonna. This is just a quick chart of how to maybe kind of draw some resistance and support areas. Again, it can be kind of subjective, so be careful with that. And then what to do with the information? Well, once you understand this, you too should be more professionally educated and should at least consider trying to make money in all markets. This is one of the reasons why I became a more active investor or trader, because now that I have this information, I can put it to work. The whole idea of investing for the future is a worthwhile discussion, and it should be tailored for you and your life. You're going to invest in something, so why not invest in something that gives you a return on investment? The question is, how much is good enough? So historically, the overall stock market returns over 10% per year. That would kind of be considered our benchmark. One of the problems with passive investing is that what do you do when you want to use your money but the market is down? That happens to many people. And it can happen in any market. It can happen in the stock market, real estate market, bond market, whatever. So that can be a rude awakening for some people. So more active investing is a choice. It's a choice you have. Um, you can manage your own money, but you need to get some education first. So as we look at our 4 market cycles, which apply to any time frame or any market or individual security, we can try to time our entries and exits. This is the basics of market timing and technical analysis. It's not easy, but it can be done. So this is just a quick slide of some of the pros and cons of passive versus active investing or trading. I'll let you guys read through these. I'm not going to go over that. But again, we're going to wrap this up in a picture. This picture, you should be seeing this picture now in all charts that you look at of any security or any stock or ETF. So once you can internalize this picture, it should really help you out, especially if you use multiple time frames to confirm what you're seeing. Again, you're going to have accumulation, greed, distribution, selling, fear, and back to stage 1 again. That's what you're seeing here. Again, when companies go through the cycle, they're either, when they get back to stage 1, they're either going to succeed and continue on back up, or they're going to go out of business if they're not making money. And I think you're going to see that more and more in the upcoming year. So if you can internalize this picture, you should be able to make money in stocks. Now we're going to go quickly to basics of a candlestick. I think I've covered this before, but we'll go over it quickly again. Candlesticks can be any color of your choice, depending on what platform you use. I mean, you could use blue and yellow, red and green, white and black, pink and orange. I don't care, just as long as you can interpret the information for yourself. I use red and green because that's what's most common. But generally, green candlesticks are considered bullish. Red candlesticks are considered bearish. But these are just a few pictures of what you might see in a chart. As we look into these candles, we can see how they form. The low of the candle will be the low price. The high of the candle will be the high price. That would be the range of the candle or the size of the candle. The top or the bottom may have a tail or a wick, just like a candle has a wick. That's why they're called candlesticks. I use the term tail, so if you hear me use the term bottoming tail or topping tail, that's what I'm referring to. The body of the candles is the colored shaded area. That can be a very, very thin body, like a doji candle, or it could be a big, large, fat, engulfing candle. Some candles won't have any tails, okay? The main difference between red and green is where they open and where they close. A green candle opens at the bottom, closes at the top, showing prices appreciated during that time period. A red candle opens at the top and closes at the bottom, showing prices depreciated during that time period. So that's what you're looking at when we put these candles to use inside of our market stages. It's just a quick view of a monthly chart of the S&PY ETF, which tracks the S&P 500 index. I think we can see there it's pretty much been in an uptrend for about 12 years. Weekly, as we zoom in, we can see we had a pullback in March and April of 2020. We had a resume of an uptrend, and then we've went to stage 3 and into stage 4 there around since the beginning of 2022. So you can clearly see now stage 1, 2, 3, and now we're in stage 4. Daily is pretty much all stage 4. So this is just a daily view, daily prices. In an hourly view, you can see it's kind of more of a sideways trend. And even within that, you can kind of see some up and downs. That's all you're looking at there, just an example. So no discussion of trading would be complete without at least looking at some basic risk management rules. These are guidelines in my plan. I have other additional rules, but these are just a couple of basics. So let's say you had a limited amount of capital, which we all do, to trade with or invest with, and you had an account value of 10,000. So you need to come up with, in your mind, a maximum dollar amount or a percentage amount per position to avoid any overnight gap risk. And I'm going to show you on the charts why this is important. And or a catastrophic loss of all your capital. In other words, don't have all your eggs in one basket. So for me, if I look to buy any stock or ETF, if I was to do this, I would limit my risk to $1,000 for that position total. And even that may be considered high. However, when we use a stop loss in our next rule, we can reduce that further. So our maximum risk per position when we use a stop loss order, which we'll discuss more, which will be considered risk value or R value, is just simply our entry price minus our stop price. And this will give us a number that we can use to calculate a maximum loss if we're stopped out of a position. So here, let's say we bought a stock at 50 and we had a stop loss order at 40, we would have a $10 risk value per share. So if our total risk that we wanted to take on this trade, and we want to limit that to, let's say, $50, we could buy 5 shares. And using rule number 2, if it's a $50 stock, we could buy up to 20 shares at any one time. So you want to have a couple rules that are in place so that you don't exceed some common sense limits. So shares per rule 2 would be $5 per share max. And I think I read that wrong, but I'm not sure. Anyway, so in my plan, I also have a maximum number of trading positions of 10. And this doesn't include anything I'm holding long term, but it used to be a lot higher. I used to regularly have in my trading account like 30, 35 positions, and that got to be too much to watch. So I whittled that down to 10. And whatever happens with those 10, I just manage those 10. That's a lot more, um, it's better for me, better management of my time too. Then I usually keep some kind of cash reserves for other opportunities that may pop up. So for me, that's 10 to 20% cash at any one time. So that's just a couple of things that kind of keep you out of trouble that I use. I use other ones too, but that's just some basics. Now within our market cycles and within our candlesticks, this is what I look for. This is my main buy setup. If you can picture these three candles, and they come in different forms, as long as other conditions are satisfied, okay, such as we're transitioning from stage 1 to stage 2. And this is how I will look to enter a trade. I'll either look to enter above this change of color bar, above this green bar right here, okay, or I'll look to enter above the first bar up here. And many times you'll see that this third bar on the right will open about halfway up the second bar, go up, exceed this price, and by the end of the day, it's right up to the top of that. So you can buy towards the end of the day or end of that time period. You can buy the next day. You get a buying opportunity the next day. It just gives me a lot of confidence using that setup. I found that to be better than necessarily trading stuff like breakouts and continuation patterns. I prefer this picture for my trading style. So now we're going to go right into Zoom. And why I chose this is just because it's something I saw. Okay, no particular reason. Certainly no fundamental reason. And on this chart, how many of these 3-bar turnarounds can you see? Just quickly, if I give you 5 or 10 seconds, can you just kind of look from left to right and just kind of just look, and can you kind of see where prices would come down, put in at a low, and then the next bar would kind of open and close higher than that one? I could see several. Who knows, maybe 10 or more just on this quick chart. So what caught my interest in this chart was the gap down from the previous earnings into a sideways trend. And then we started to see interest pick up. We started to see volume pick up. And we started to see the candles get bigger again, where buyers seem to be more interested at this price. And it became more and more clear to the right side of the chart that this was a possible trade. Not for sure, but possible. So let's take a look at the next chart. So we had a very bullish close at the end of the week. And that last candle closed on Friday over all that previous resistance to the left, going back to that gap down after earnings in August. That's quite a bit of time, August, September, October, November. So that gave us some time to watch this. So let's go next. So you need to take some of this information, not only as it's presented, but in context of a market cycle. And I'll show you guys that in a chart here coming up. But this is just a basic daily chart of Zoom after it closed on Monday. So the previous chart was Friday. This is Monday. And so is that red bar after Friday significant? Because it actually gapped lower and closed lower inside of the previous bar. So it was an inside candle. Top of the candle and the bottom of the candle were inside of the range of that previous green bar. I didn't feel that was significant. I felt that was just kind of a little bit of a pullback. So now I was even more interested actually. So let's go next. Here's a Zoom video. I highlighted just some notes on this. I'll let you guys look over that. But basically, I want to draw for you what a pivot high or what a pivot low looks like, where the gap was, where resistance was at short term, kind of what we're looking for as far as a 3-bar turn. Um, we had 100% retracement from a pivot high to a pivot low, and then we had an immediate turnaround after that red bar, and then followed up by the green bar. Can you guys see our 3-bar turn there on the right? So that was like, that's pretty good. So that's why I was interested in this company. So I'll let you guys look over that. Next. Then we had this candle. So we had, in my opinion, this fourth candle after that shakeout candle, that big red candle on the bottom, and that confirmed that we had a new pivot low. And we had a pivot low here, and we had a pivot high. And we came back 100%, put in this pivot low, and kind of shook out the market, and immediately put in this green bar the next day. So to me, that was positive because we had this shakeout, a higher low, higher low, higher low, and a fourth higher low, all the way back up to 87 from about $71. So that's a pretty significant move in 4 days. Sometimes an inside candle will indicate, regardless of color, just a pause in the short-term trend and not necessarily a reversal. So here we're kind of looking towards a continuation trade. And so if I was to take this trade, we could talk about an entry point, which would be over the high of this candle right in here, and a stop below this candle or below this candle, giving us a pretty decent risk profile of, a couple dollars to maybe $3 per share, and maybe look for our target for this candle on the left, this gap area, which would be around, I don't know, 96, 97 bucks. So you can see it's almost a $10 move. If you went from here up to here and caught that move, you could quickly make $10 per share. Now, if it doesn't work out, of course, we have our stop in place. So this creates a little bit of a risk to reward discussion, okay? So we have a confirmed double pivot bottom, or a bottoming pattern. And we had a breakout over resistance and a shakeout and a breakdown failure on this area right here, this red bar. So now we can maybe consider a continuation trade, if that's in your trading plan. We could enter over today's open or over today's high. Let's use today's open, for example, last red bar. So we could enter over 88.25, put in our order in the system, and a stop under today's low of 85.72. Now we can look at our risk to reward ratio with a short-term target of the gap fill area of 96 or so. And we can do that math. So we have about $7.75 potential with a risk value of about 253, which we can calculate out as a ratio of about 3 to 1. And if we entered and exit where we planned. Now this is a lower odds trade, mainly due to price being up, 4 to 5 days in a row at resistance, 100% retracement back to the top, more than 100% actually. And so, we're also still in stage one in a bottoming pattern, so that can also be treacherous. But let's see what happens, okay? So let's go next day. So on Wednesday, we've got this. And we put in a lower low. We actually gapped down and put a lower low this day. So now we're going to start to, okay, so this continuation trade, if we entered it, never triggered over this day's high. Never triggered because the next day we immediately gapped down and went lower. So now we have to rethink, okay, so this is not a continuation trade for sure. So what can we do now? Well, maybe we can look for our buy setup, okay? So we're going to look for our 3-bar turn pattern right here and see if it materializes. And some of the negatives on this chart where we had 3 really strong days up and then 3 kind of wimpy days kind of coming back in with 3 red candles. We have 4 higher low candles, and we had really kind of below average volume. So, and now we also have kind of more of a confirmed breakout failure and a new pivot high at about 110% retracement back up. So that's what made this kind of a low odds trade anyway. But it didn't work. We didn't get triggered. So let's just continue to watch. So this was Thursday after the close. We had a green change of color bar. We're still looking for a setup, our 3-bar turn. We did not really get it, did we? We were looking for something to open above this candle here and actually put in a bar here. So we didn't get the previous picture we were looking for. We did not get this picture. Okay. What we did get was a small body candle, a green candle with a new low. Well, I should say a lower low. So it just appears that prices are pulling back and consolidating through price. So now again, we're going to look for this buy setup again. This would be a safer entry versus buying down here at this double bottom or buying above this green candle here. Essentially looking to buy over this green candle or over this red candle, somewhere around the 85 area, maybe 84 area, and see if we can catch the move higher. Because this is looking like a higher, potentially higher pivot low. So this will be a little bit more of a buy setup, maybe an anticipation trade. Price is going back up after this strong move up off of a double bottom. So next, I just threw this in and I highlighted some minus and plus areas where I just felt emotionally like this was a negative in this portion of the chart here, right? Gap down, prices moving down, that was negative, and then positive, they popped up. Positive area here again, they popped up, prices started to move up again, so that felt positive. And then we had this negative right in here. So I just threw this in here because just to kind of highlight maybe some of the emotions somebody may feel if they were in this trade as prices move up and down. So now we've got another point to make about this would be the potential of what's called a head and shoulders or a reverse head and shoulders pattern where we have this left shoulder, kind of this head with a shakeout, and then maybe a higher right shoulder. That's kind of, if we combine that with our 3-bar turn, that's a pretty high odds trade. And so that's why I threw that in there. I explain a little bit here in the text about really what this shakeout means and kind of what happened as far as some of the internals that are going on in the market. But basically what you're seeing there is something that was on sale that all of a sudden buyers could not resist. Okay. So that is that. You guys can read through that if you wish. So on Friday, this is just a daily 6-month chart for context. And we actually got an order entry which triggered over yesterday's green bar. This is just a 3-month view of that. So on Friday, we had really a very weak 3-bar turn with that red bar. It had a bottoming tail which showed some strength, but it had a red close. And we never got above this first red bar here. So we didn't get that strong, red, green, and then another green bar. We didn't get that. But because I placed the order in the system, my order was filled. So I had to put a stop at around $80 as my stop. So let's see the next slide. So this is kind of what we were looking for right here. And this is what we got. So I was filled on my order on low volume. Um, Not the best looking buy setup, but because I put the order in, I was filled. And so this will continue on with our example. Right now, we can basically only hold off if we're in the trade or wait for a different entry point if we wanted more confirmation of strength like we had saw last week. So I'm in the trade. You guys can follow along. This is just a weekly chart because it was the end of the week there on the 18th, November 18th. And the weekly chart just looks kind of wimpy. You know, stage one, late stage four, stage one. And the last pivot was here, which was, 5, 6 weeks ago, was our last low pivot on the weekly chart. So remember, we had earnings here, earnings, and now this is basically a breakout continuation or an earnings trade. We're looking for that buy setup going into earnings. Again, you must use caution around earnings because earnings can be very volatile. And so this is what we got on Monday, on November 21st. So if you just look at that, you can kind of see that from Friday to Monday, we had overnight gap risk. So this is why we need to use some position and money management tools, because especially this stock, this stock seems to gap up and down quite a bit. So Friday, it actually gapped down a little bit. I should say it gapped up on Friday, closed lower, and then on Monday it gapped down and closed lower with a topping tail bar there. So that doesn't look positive for the case to go higher for sure. I was expecting a better show of earnings and a better outlook for the company, but evidently I was wrong. So it's okay to be wrong. That's one of the points of this chart. And right in here, you can see it came up and pulled back about 50% from here to here and back. That's why this looked like a pretty good buy setup, because of the retracement level. So now we go to this. Now we go to Tuesday. Now I was stopped out. I want to talk about this too. I had bought on this red candle over the screen bar on an entry order. I put my stop at 80. And the next day on Tuesday, I'm sorry, that's not right. This is Tuesday. I was stopped out on Monday. So this was Friday. Bought my order to stop was triggered on Monday on this earnings event. So I was out of the trade at that point. It only took entered on Friday, stopped out on Monday. That was it. This is why you want to do that too, by the way. On Tuesday, we have a gap down. And at one point, this is a red bar. It came as low as about 71, maybe $72, and then put in a bottoming tail and closed higher around 77. Yeah, 77.15. So now we have some more information with possible igniting volume. However, stocks that are strong candidates to buy that you're expecting to go up out of a stage one generally do not gap down to support and retrace almost 100% from a high pivot. That's the problem with this chart. Even though I got on here, was stopped here, the next day I would have been holding a larger loss. Is point one. Point two is from here to here is about 100% back down to this level. Stocks that are strong, this should have turned right here. This should have came down, and momentum should have came back into this price, especially on earnings, and went back up. So there was some interest in earnings, but it wasn't good. And then the next day it gapped down. This is why you need to have risk management in place before you ever get into the trade. So instead of, I think I took a $2.50 loss, something like that. So if I had not put that order in the system, I would have been holding almost, I think about a $7 or $8 loss per share, if my math is right. And that's how you can lose money. Even though this candle is very bullish at this point in time. It looks bullish, right? If you if you bought up here and are holding here, you're holding a loss. And so that's very discouraging if you were to hold through that. So let's see what happens next on Wednesday. It's just a highlighted chart. I made some notes on this chart, put in some squiggly lines. We're still looking for this 3-bar turn. We haven't gotten it in the last 7 or 8 days. Let's see what happens next. So on Wednesday, this is just a quick thumbnail chart of what happened. And we'll go to a full chart. This is Wednesday, daily 3-month chart. And we can see what happens next. We got this inside doji candle, which didn't really move anywhere. So that's not very strong for the bulls either, for the case for prices to go up and appreciate. That's pretty wimpy after 100% retracement. And so this is also going into, by the way, into Thanksgiving holiday. And this candle here gives us real no indication of direction at this time. It just looks neutral. So these doji candles just simply look like a plus sign. That's all it is. Now we had Friday, the day after Thanksgiving, which was a shorter trading day. And so we saw this bottoming pattern. We had a gap down after earnings into a buy zone area. Good thing we stopped out at 80 instead of holding this down to 75 or lower, because it just seems like there's no real interest after earnings in Zoom. And in fact, we put down a lower close on this day, on Friday after Thanksgiving. So that doesn't look good either. It just looks like bottom of the trading range, and nobody's interested anymore. Back to stage one, right? So next chart, we can look at, this is the end of the week. So that was Friday. So now at the end of the week, we can look at a weekly chart and gauge where are we at on the larger time frame. Well, where we're at is red candle after earnings on volume, not positive for prices going up, and so that is a situation that doesn't look like there's a lot of interest at this price level. So prices may need to come down some more before buyers get interested again. We still haven't seen really our 3-bar turn. We got a kind of a wimpy one that we got triggered on, but that you might not even see that if I didn't point that out to you. We just did not get this. We just did not simply get what we were looking for, which highlights we were wrong in our assumption, but we had the correct use of a stop loss if we were wrong, and we were. It looks like to me we're still in a stage one accumulation or just consolidation. And one of the clues that is that even after a large gap down on Tuesday after earnings, buyers stepped up again. So there was some interest, but not enough. So if we have some interest in this company, then even though we took a loss, we should not ignore any future price action. Let's just put it back on our watch list and let it cook some more. So if we're not getting what we're looking for, and we've already been stopped out once, I think it's important to step back and just take a real trade review and be honest with yourself if this happens to you. Just if you can't be honest with yourself and you can't be objective, then it's not going to help you. So you have to be honest about retracement levels and gaps up, gaps down. Are we below or above the moving average? Are we putting in new lows or new highs? Stuff like that. Just be objective. And it's arguable that the most important subject of trading is money and trade management. So it does you no good if you go all in on something that you just know is going to work and you lose all your money in the stock market. That does nobody any good. So in my opinion, you should start money management at home with a home or personal budget that you actually write down and follow and have practice some discipline to do so. If you don't have discipline to follow a simple budget, then I don't think you should enter this arena until you prove that you can. So I think people skip over this because they think they're smarter than the market, or they have a degree, or they were successful in their career, and then they come in the market with a little bit of ego, similar to maybe like a professional athlete that makes a lot of money. So, I mean, have you ever heard of a broke lottery winner or maybe a highly paid athlete? So I certainly have. It's because they didn't have money management. They just blew it. Didn't matter how much it was either. Um, but I also personally know people like janitors, teachers, and truck drivers and tradespeople who are millionaires. It's just not rocket science. It comes down to discipline and money management. So again, we can dig deeper into why it's important. And on our example of Zoom, our order had triggered at 83.34 over the previous day's high of 83.21. So we entered our stop loss order at, I should have put it 79.95. I put it 80 for whatever reason, under the previous day's low. So that set up our risk to reward profile. And we had a risk value of 339 per share based on our stop loss. Now this is where you need to really consider your position size, because 10 shares of this company, I took 12, would be $33.90 risk for this trade. Now, if you had 100 shares, right, because you would risk $339 based on those numbers. So your account size and risk can be controlled using a risk value. You decide how much risk is acceptable to you. That's not up to me, that's up to you. You need to calculate risk before you ever enter a position. So we entered this on Friday with our assumptions in our stop order in the trading system, just in case we were wrong. On Monday, we were wrong. The share price gapped down and opened on Monday at 81.21 and had a low price at $79.77, below or under our stop order of $80. So we had a losing trade and stopped out and closed the day at $80.26. How much did we lose? We lost $3.39 per share, or $33.90 for 10 shares. How much could we have lost if we did not use the protection as advised and held the trade for a few more days over the weekend, right? So, what if we did not believe this stock could go any lower? I mean, it's Zoom, right? I use it all the time. It's a great service, great company. It can't go any lower. It's on sale. Well, on Tuesday, it gapped down and opened at 75.18, almost $5 lower. Had a low of the day at 71.90 and closed at 77.15. So you would have lost over $3 per share more based on this closing price. Unfortunately, what becomes oversold can become more oversold. And what is on sale can essentially sit on the shelf and be more on sale. On Wednesday, what happened? It gapped down again. It closed lower at 75.40. So if we closed at today's price, we would have lost $7.94 per share, or $79.40 for 10 shares. But let's say you're a big shot and you bought 1,000 shares and went all in because it's Zoom and it's popular and you work at home and you work in the tech industry and stocks normally go up after earnings, right? Wrong. You just lost on paper, or if you close your position on Wednesday, you lost $7,940 in a few days. That's $7,940 in a few days. Sorry for you. What if you sold at or near the low Wednesday? Well, if you had a $10,000 account, you just lost about 80% in one trade in a few days. If you had a $100,000 account, you lost about 8% in a few days. Well, that's still not acceptable. Some people invest and hold all year for an 8% return. So we need to put some of this stuff in perspective. This is why stock traders and day traders and even big hedge funds go bankrupt, because they do not have control of their emotions or their egos or their money or trade management. This can really happen to anyone at any time. You only need a few bad trades or a few bad days or a losing streak to give away your hard earned money to someone in the business who plays by some rules like me. I tell this cautionary tale because it happens all the time, just like accidents on the highway, whether you see them or not. Unfortunately, there is nobody to call if you have a stock market emergency like a market ambulance or a paramedic. You will be out of money and out of luck. Nobody will call and ask if you're okay or can we try that again or ask which college you graduated from or what is your title at work. This all takes place on computers and there is no going back. You must protect yourself. Our example highlights the need to use money and trade management, some common sense, and to enter the industry with understanding that it is different than other businesses and the risks are real. So don't go out and put your trades on a credit card or a student loan or a HELOC loan on your house because all you will get is an email at the end of the day with the result of the trade, like the one in the picture. Please take this seriously. You will have losing trades unless you simply buy and hold for the long term. Even then, the market goes up and down during certain periods of time through our four market stages. I showed this email to you because it is real, and I took this losing trade for our example, our benefit. So let's go there now. This is the buy order that I had entered for Zoom on that day and how many shares and at what price. So you can see I bought 12 shares at $83.34 using a limit order. On anything under 84, I was willing to buy. Next slide. This shows the stop order, right? So I stopped out at 80, sold 12 shares at 80, so I had a losing trade. I show this to you because it's okay to lose. It's okay to lose some battles, but don't get kicked out of the game. Don't lose the war. It happens all the time. So here's just a few more risk rules. Actually, that's the same slide from before. I just want to repeat it for you guys to show why I use some of these risk rules. Again, if you don't have a budget at home, here's a quick and easy and dirty one for you. Income from your job or business. Write it down. Write down and be honest with yourself about your expenses, especially if you have any debts like cars, credit cards, or fast food that you are normally spending your money on. And then write down what's left over. If there's nothing left over, then you need to earn more money or quit spending so much. If you have money left over on paper, but you don't have it in your account, why is that? It's simple discipline. You're not setting it aside for a rainy day. If you only saved $100 a month, okay, over the next year, you would have $1,200 to invest or trade with. And now you can kind of maybe get a little excited about it and you can start researching what stock would you buy if you had $1,200 to invest. Bottom line for me, no pattern, no setup, no management, no compelling market cycle, no trade. That's the bottom line for me. Let's continue on to the next week following our Zoom example. So on Monday, this is not what you want to see if you were an owner of stock or had a long position or a bullish position. Large red uh, candle with a topping tail, basically almost engulfed the previous 3 days and put in a new low. So imagine holding the stock now. If you didn't have any trade rules, well, you'd be just simply holding a greater loss. So we got a bearish new low, new red candle low. We've been down almost 8 days. Maybe a triple bottom, we don't know. But if you take a loss sooner, you can always enter again later when conditions are better. Do not marry these trades or these companies. It's volatile right now. Tuesday, we have what? Another red day, another 52-week low. How low can the stock go? What stage are we in this chart? Is this company going out of business? Well, we thought 80 was the low. We thought 70 was the low. We thought 75 was the low, and we just put in a new 52-week low. So that is not good. Answer, if you study the market stages that I had pointed out earlier, is we are in a stage 4 on this daily time frame. Doesn't matter that we went from stage 4 to 2 quickly 3 weeks ago and made a double bottom. It does not matter that 4 days ago we had a green bullish bar with a bottoming tail on volume. It does not matter what we think of Zoom or if we just know that this is our favorite company. We just put in a new 50-week, 2-week low, and we're down another 1.42% in one day. A triple bottom broken. It's not a good idea to be bullish at this time, thinking it can't go lower, or I know it's worth, whatever dollar amount. Let's say $100 based on my price to earnings and revenue analysis. If you really believe that this, you just know it's worth $100. If you really believe that based on your analysis, I will personally sell you all the shares you want today for $100 per share. The bottom line is, it's in a stage 4 downtrend at $70.57 closing price. And I extend that invitation to anyone that thinks this company's worth $100. I'll sell you all the shares you want at $100 on Monday. Now, on Wednesday, we get this large green engulfing bar. Yet another new low. We're in a support area. We're in a buy zone area, so this is not a good place to go short either. But this is the picture we've been looking for. Unfortunately, it happened. It's not at a great time. Now, we could take this 3-bar turn trade maybe as a day trade to maybe go back up towards 80. But this is something I don't generally do. I'm looking for longer term moves, more substantial moves. So for me, I'm just watching and waiting at this time. But this could be a good day trade. So I also want to highlight for you guys that we want to see that 3-bar turn 6 days ago. It's just simply too late for me. If buyers had stepped up on Tuesday, November 22nd, then this 3-bar turn would have been a much higher probability trade, pulling back only about 50% instead of 110% and making a new low. So this just highlights in yellow kind of the general stock movement and how we went from a certain level up to a certain level, back down 100%, back up 110%, and then back down another 110%. So this is kind of volatile. Now, some traders will make money on this volatility. And I have made money at certain times with volatility, but again, this stock likes to gap. It could very, very easily gap down to $65 or $60 tomorrow. We don't know. So we make some assumptions, but we also have to use some common sense. On Tuesday, we had this gap up. This is December 1st with a green bar. It had an expanded range, but a topping tail to close the day and kind of just average volume. So what does this suggest on this chart? To me, it suggests that there's clearly some resistance over this area, over maybe $78 or $80. And this looks like a possible formation of a lower pivot low, just as we had a new low pivot low. We may have a new lower pivot high now starting to form. So this is why I wouldn't have taken this 3-bar trade right here, is because of this. Prices popped up, gapped up, went higher, and then closed higher, but had a lot of selling during the day. So as a day trader, yeah, you could have made money. But if you didn't get out at the end of the day, then it's very possible you could have lost money too, depending on where you entered or exited. So let's go to the next chart. So this just simply suggests to me a continuation of the downtrend. And that topping tail bar, that's what I see when I look at that. I see a lot of selling on that bar, probably about 70 or even 75% of that day was selling, not buying, even though that was a green bar. So you don't need to jump in on these trades. The market will be there tomorrow, and let's just watch and see what happens. Another thing on this chart that happened was we had kind of an area of support around 80 or 79, and now that's acting like resistance to prices going up. So what was the floor has kind of now become the ceiling too. That's another negative I see. And we're below the moving average too. Next chart. So on Friday, December 2nd, this is what we got. This is kind of what I had expected for on Friday. Some type of bar with a lower price from the previous day and a lower close. That's exactly what I expected. And buyers are essentially giving up and regrouping. And you can see that in the volume decline on the bottom of the chart. See where there was some excitement around, maybe 71 or 72. Now, there's not so much excitement anymore. Buyers are starting to say, well, maybe this thing isn't worth that much. Let's see what happens. So now people are just holding their money, waiting for the next sale. That's what they're looking for Zoom on sale. So we've also a few more days down, and that top and tail bar will be a confirmed lower pivot high after a lower pivot low. And you can see I draw that line there with the declining volume. So we had some interest going into earnings. We had some selling off after earnings. And now we're not even getting much buying that's taking place. It's more selling taking place. So this is simply a downtrend within a stage 4 in this time frame. This picture is telling us weakness. Lower prices are most likely. So if I was a weather forecaster, I would be forecasting rain, right? Or I would be forecasting lower prices or lower temperatures. So expect the best, but plan for the worst. If the picture changes, then we must also be willing to change our approach. Well, the picture changed from, 6, 7 days ago. So we have to be willing to change with that picture. Now this is interesting too, because I'm gonna take a drink real quick while you guys look at that. So what stage are we in now on this time frame? So this is a monthly 5-year chart. It's pretty clear to me we're in late stage 4 or continuation stage 4, maybe an early stage 1. This is a monthly chart. This is 5 years, okay? So Zoom went public in 2019 at 65 per share, and then made a high of almost 589 per share in 2020. That is quite the move for any company. I mean, how low can it go now? Well, when the different time frames line up, then that is the most likely direction of price. So this just highlights market cycles, market stages, just where we're at with this company. This is why when I did my trade review, I was like, why did that fail? And this is one of the reasons it failed, is we are in a continued downtrend. And very likely going back to 65 per share. So imagine being a holder of Zoom when it first came public. Okay, how would you feel if you bought in 2019 at 65? Watch it go all the way up to almost $600 per share, then held all the way back down. So one thing we're looking for in this chart, we're looking for a big fat volume spike like this, big fat bars over here. When we get that at around some level, I don't know where it'll be, but if and when we get that, that will be the time to really look to go long Zoom, because that's going to tell us that everybody that bought sooner, held through all this, didn't sell at 600, didn't sell at 500, didn't sell at 400, did not sell at 300 or 200, and is now holding at this price, is probably saying, dang it, I give up. I'm out. And when enough people do that, you'll see a big volume spike, which will signal the possible end of this downtrend and signal either stage one, it'll signal going out of business, or it's going to signal a possible new stage two uptrend. I don't know if or when that's going to happen. I'm just saying this is what the forecast is telling us. Eventually, sellers or buyers and holders of the stock are going to say, that's enough. I can't take it anymore. And they're just going to all throw their shares away. And that's when you'll see a big volume spike and either renewed interest in this company or no interest in this company. Then we have a weekly chart, which is basically the same picture as the monthly chart. It's just a little more defined, but you can still clearly see stage one, two, right, three, and then stage four. Maybe turning back into stage one. Okay, this is why these stages are important. It gives you a mechanism to judge when is a good time to buy. Is it really on sale, or is it just a company that nobody cares about anymore? So this is a weekly chart zoomed into a 2-year time frame. Same information, but just kind of zoomed in. You can see we're trending below this moving average. So that's another negative. So this is a 1-year weekly chart. We sold off again after earnings last week. So in the last 4 earnings periods, we've sold off after earnings in 3 out of 4 of those periods, indicating market weakness and probably a weaker outlook for the company. Normally, companies that have good earnings will have a lot more excitement going into and after earnings. So this tells me that investors in general are not too excited about Zoom. So again, this is a daily chart. Just to recap, 6-month daily. On the daily chart, it looks like we just resumed downtrend. We're clearly to me in a stage 4, and we just have to wait and see. One more view of the 3-month daily chart as we wrap up this presentation. Again, we need to know what stage are we in and what trend is happening within that stage. Does the pattern that you look for appear, and is it the right time to buy or sell? In this chart, I can clearly see my favorite picture of a 3-bar turn after a pullback, but it is at the wrong time and a new downtrend move in a stage 4 with a new low. So this concludes our look at a company stock over several weeks and how we can use the 4 market stages of price trend analysis. Just break it down day by day and bar by bar, week by week. Okay. Hope this helped you guys out. This is definitely something that I use in my weekly game plan. Let's say I have 10 stocks in my portfolio. I'll go through each stock on Friday or Saturday or Sunday after the market closes and just take a look. Where am I at? Where are we at in this market? What market stage are we in? When I zoom in, what do I see? And this will tell me buy, sell, or hold. Yeah, one final picture of 4 market stages with just kind of an average line on that for you. Again, different names for the 4 market stages: accumulation, buying, consolidation, or even indifference sometimes in stage 1. Stage 2 is the buying stage and the greed stage. Gotta have it. Stage 3, distribution, selling, consolidation, and maturity. And finally, stage 4, fear. We're just got to get out. Can't take the pain anymore. Then either the cycle starts over, company goes out of business, or product falls out of favor. And that's what happens. Anyway, thanks for putting up with my artwork, guys. I'm not an artist. Good luck investing or trading. Again, this is Phil. I'll be at Laptop Trader on YouTube, and you guys are welcome to watch, learn, follow, and subscribe. Thanks. Bye, guys.